This video is for Canadian investors, and it is relevant only to them because I will talk about Canadian banking system as well. So Canadian investors, I understand that you invest a lot of money in higher risky investments like equities or mutual funds. It's very important to invest in risky assets if you have a long term horizon, and if you want to get a good growth over the time. But it is also important to move that money out of the market based on your goals. For example, if you have invested your money in the market, and that is in the mutual funds or in the equity form, and you invested for 10 years, right? Because you want to buy a house in 10 years. So it is your responsibility to monitor the markets, especially after 8th or 9th year. Why it is so important? For example, if there is a crash in the 10th year or in the 9th year, you have already moved your money out of the market. So if you see that in the 8th year or the beginning of 9th year, the market is really good and you have gained good growth on your investments, it is the right time to convert your asset from equities to GICs or in the cash form, so that at the end of 10th year, when you are ready to buy your house, you have preserved your accumulated wealth, which is as important as investing your money in the market when you made the investment decision. Because you don't want to feel crushed if there is a recession, if there is a crash in the economy, when you are redeeming the money out of the market. So make sure when you invest your money in the market, it is always based on some goal, and you are monitoring the investment, especially the last couple of years before you withdraw it, so that you don't feel or you don't get a loss, because then you will lose your trust in the investment industry and you will never invest your money in the market. Also, and it is very important, whenever you invest your money in the market, and suppose if your goal is for 10 years, and if you are withdrawing money in the first 2 years or the third year, and if you see that the funds are down, then don't blame the market for your loss. It is your own loss, because initially you made the decision to invest for longer term, but now you are withdrawing the funds. So 50% of the times, or more than 50%, I have seen that people talk bad about mutual funds or equities or growth related securities because they get a hit in the short period of time. So just remember that. I believe you are well aware of this fact, that whenever you are investing for long term. If you don't have the long term goals, then you are just saving money in the cash form, in the savings account or the GICs, or in Indian terms FDs. So that's the thing that I wanted to discuss, because I have seen people lose money because of the negligence or the lack of awareness about this matter.